Good morning, everyone. Rich Yamarone here. Welcome to the latest edition of 5 Questions with Rich Yamarone. My guest today is a friend, a personal friend of mine as well. Todd Schoenberger, the managing director of Land Colt Trading. He's got plenty of decades of experience. Certainly, I've known him for at least one of them. And we've dealt with each other for a good number of years, good number of topics. Thanks for coming here today.
Well, thanks for having me here today.
Okay, question number 1. Look into your crystal ball.
Okay.
Tell me what you got for what is the state of the world, the global economy, the global world, the global stock markets. What's everything look like 6 months from now, February 2011?
Well, if things continue down this path, we'll enter into probably a catastrophic phase right now, and mainly because the U.S. economy is slowing down at an epic rate. I mean, when you have a first print on GDP of 2.4%, and now we're headed lower, and we have to look at the average as far as the second revision, we have to think that by the end of the last Friday of the month, we could be well below 2%. So when you see that, and you see that setting the pace of what's going to happen as far as the global economy, yeah, I think we could be in dire straits in 6 months from now.
Dire straits. So question number 2, I guess, it brings me to inflation, deflation. You're probably in the deflation camp, no?
Well, I am in the deflation camp, but here's the thing. You really have, the Fed's move last week was probably, I call it diet QE, because realistically, they haven't been able to really pull that trigger as far as going full-fledged quantitative easing, but they will eventually have to do that. I think that Bernanke and company actually see something that's on the horizon, so you're probably going to see an issue down the road. If they come out and start throwing more money into the money supply, increasing money supply, clearly then that's going to inflate prices later on. But right now, yes, we're in a clear deflationary camp.
Can the Fed do anything else, though?
Well, there's really not much they can do. There's really only one thing left that they can do, and that's increase money supply. Obviously, if they decide to go into some type of treasury buying program, unlike what they already announced with mortgage-backed securities maturing and them going into buying treasuries. I'm talking about actually creating their own cash, printing cash, and then going into buying more treasuries. Yeah, that's probably the last thing that they can do right now. But they really put themselves in this hole. I mean, they cut rates at an epic rate, if you really think about it, going down to 0 to 25 bips. And now what can we look forward to going forward? I don't know. They really maybe only have 1 or 2 bullets left in those chambers.
Yeah, and sadly, they're the only game in town. The fiscal situation, Republicans pretty much tell you, hey, we're not going to, there's nothing we're going to do until at least January 1. We're going to have the sunset, or the Bush tax cuts are going to expire. So there's really no fiscal policy. We only have the Fed, who's got, as you mentioned, 1 bullet left in his chamber. And that's what leads us to this catastrophic forecast that you're pretty much looking at?
Well, you're spot on with that, Rich. I mean, everything you just said. I mean, when you start thinking about taxes as far as the uncertainty issue that we have facing not just the U.S. economy, but also the global economy. I mean, if you think about, just look at the small business owner. If you look at the most recent jobs report, you saw 159,000 jobs in the small business category eliminated. That was on top of 301,000 a month prior to that. That doesn't look good. When you start thinking that 60% of all jobs that are created in this country alone are from the small business owner. If the small business owner is uncertain about higher taxes, don't forget about health care costs that are on the horizon. When you look at those 2 things, plus an uncertain economic environment, yeah, it doesn't bode well as far as hiring, adding new discretionary income back into GDP, and then obviously with globalization. It just does not look good.
So, crummy environment, devastation is your word, not mine. What do I do with my financially? What do I do? Stocks, bonds, holdings. What do I buy?
Okay, well, a couple of things here. One, you can experience a lot of volatility. You have 70% of the market of the trading days so far this year. We've had a triple-digit swing. 70%. Now think about that. 5 years ago, we experienced 2 triple-digit swings a month. That's it. You have 7 out of every 10 days now. We have incredible volatility. Investors that cannot stomach this risk right now, that really don't know what they're really looking at, they really should stay on the sidelines. They probably should stay in cash. There is going to be a revolutionary change as far as once the midterm elections hit. That's probably going to be your entry point back into equities. Look for a Santa Claus rally after that. But all we can hope is that President Obama goes back to doing what Bill Clinton did in 1994 and really try to be more centrist as far as monetary policy. If that happens, then I'll I'll come back on your show and I'll be a little bit more bullish and optimistic.
Well, we're definitely going to have you back, and we're definitely going to hold you accountable or praise you. We'll give you an award of some sort. Finally, I just want to say, I was going to ask for the. I like to do this. I like to ask for the wildest prediction you could possibly come up with. But you're throwing some pretty wild prognostications out at me. So, but why don't you give me something that maybe is not a top of your worry list or forecast list, but it's something that you definitely wouldn't be surprised by seeing 3, 6, 9 months down the road.
Okay, 6 months down the road, realistically, we could hit 10.5% plus in unemployment. If you look back at when the Fed hinted at quantitative easing in December of 2008, we were sitting on a 7.4% unemployment rate, and plus we had core inflation of 1.8. Now we're at core inflation at 0.9, and you have a 9.5% unemployment rate, and plus the prospects of jobs. You still have jobless claims that are dancing with 500,000 right now. These are all recessionary undertones when you think about it. What I would actually predict for investors and for traders is that starting probably very early in 2011, yeah, we will clearly cross a double-digit point in unemployment. Realistically, though, we could be looking at 10.5% at that time. And if that's the case, we're in big trouble.
Well, especially the consumer sector, and
right.
subsequently the whole entire U.S. economy. Thank you, Todd. Everybody, want to thank you for joining me and my guest, my dear friend Todd Schoenberger, who's the managing director at Landcolt Trading. And we will see you next time, and we will bring him back if he's not right.